Hey, this is Chris, and in this video I'm going to be reviewing the Inverse or Bear ETFs listed on the ASX. Their ticker codes are BEAR, B-E-A-R, BBOZ and BBUS, and I'm going to be talking about what they are, how they work, and how I think about them and their effectiveness when it comes to hedging or protecting your portfolio. So first of all, what are Bear ETFs or Inverse ETFs? These are basically a suite of ETFs that have been designed to give you the opposite return of a share market. The ones listed on the ASX aim to give you the opposite return of either the Australian share market or the US share market. And they don't ideally give you a perfect one-to-one relationship. They have a level of hedging that changes over time, so they can give you anywhere from a one-to-one relationship to a one-to-half relationship to a 2.75 to 1 relationship. So they give you some sort of multiplier on the market return in the opposite direction. And they're basically sold as a way to help to protect your portfolio when markets fall. So how do they work? Well, on a one-day basis, if a one-to-one inverse ETF has a ASX return of 1%, the inverse ETF will give a return of -1%, and vice versa. If the market falls by 1%, an inverse ETF giving a one-to-one relationship will give you a positive 1% return. So how do I think about them in a portfolio sense? Well, certainly as day trading tools, they do exactly what they say, which is give you a return inverse to the market. So if you're punting on the markets day to day, guessing where the markets are going to be up or down, they will help you give an opposite return to the market. But unfortunately, that's where the effectiveness of these products ends, because over any medium or long-term horizon, regardless of whether markets go up or down, these products destroy your wealth. A great example is recently the Australian share market over a 12-month period had fallen 6%, but the double leveraged inverse ETF, which you might expect would give you a return of positive 12%, which is 2 times negative 6% in the inverse, actually lost 16%. So they don't do what you would expect probably over the medium and long run, and this is due to a couple of reasons. It's due to the cost of leverage. It's due to the cost of having to fork out those dividends if you're short these stocks. And it's due to this concept of decay, that basically these products are constantly going backwards because of the cost of owning them. And so really my view is that these products aren't suitable investments for anything more than one day. The only winner out of them really is the ETF manufacturers themselves, who are earning huge numbers of fees out of these products every month. But ultimately, they're going to consistently go backwards, and they are not effective diversifiers. If you want to have a look, pull up a chart of any of these products, BEAR, BBOZ, or BBUS, and you can see that over their lifetimes listed, and they've only been listed for about 5 years at the moment, they've fallen from anything from 62% to 92%. So if you'd bought them on day one as a way of hedging your portfolio, you've now lost 92% of your money. So even if they double from here, you've still lost most of your money, and they're really ineffective to hedge your portfolio. And that's why I really think these products don't belong in the group of ETFs. They shouldn't be considered ETFs at all. In fact, I would be pushing for the regulator to pull them out of the share market altogether. They're more like gambling tools or binary options, and they don't have a place in anyone's portfolio. Ultimately, if you're trying to protect your portfolio, the only proven way to do that over the long run is through asset allocation. That is making sure that your portfolio not only has growth assets, but also has defensive assets, whether that's cash, government bonds, or assets like gold, because these are assets that actually hold their value over the long run and protect against market volatility, and they're not going to destroy your wealth like inverse ETFs. And that's my review of ASX listed inverse ETFs.